Welcome back. A rally is underway with about an hour away from the opening bell. Dow Industrials up 214, NASDAQ up 42, S&P higher by 26 after First Citizens Bank and Trust Company announced it will acquire nearly $72 billion of collapsed Silicon Valley Bank assets. This acquisition at a discount of about 22%. Meanwhile, the Federal Reserve is also considering expanding emergency lending programs for the First Republic Bank. That stock also rallying. It's up 26% right now on that news. Joining me right now is the CEO of ERShares, Joel Shulman. Joel, great to see you. Thanks so much. A very positive reaction here to this acquisition of Silicon Valley Bank. Your reaction?
Well, the First Citizens is getting a discount. I mean, they're up about 20% pre-market, and clearly, you know, they're being encouraged to take over this company. There's a lot of good loans on the books, and they're getting at a huge discount. So I think the market's responding to that, and the market overall is responding to a lot of interesting news here. That we've had interest rates drop. We've had a parallel shift drop, parallel shift down in the yield curve, about 50 basis points. Last time we saw this in January, the markets rallied, then the markets went back up, a parallel shift up in February, and then in March now we're seeing a drop again. So the markets are responding to interest rates first and foremost, but it's a two-tier market. Weak credits are getting hurt, the spreads have widened, particularly among junk bonds, and those stocks are under pressure.
Yeah, it's all great analysis. We've got the Federal Reserve president of Minneapolis, though, Neil Kashkari, saying that bank strains are bringing the U.S. closer to a recession. You had IMF chief Kristalina Georgieva warning of increased risks to financial stability. What are your thoughts there? Because I spoke with Judy Shelton, the former Federal Reserve Board nominee, on the impact of this crisis on Friday. Here's what she said.
There's a crisis of confidence, and so the risk of contagion is definitely there. What concerns me is the level of derivatives. It's just almost mind-boggling. There's 600 trillion in the nominal value of derivatives out there. And when you see these changes in interest rates that are so rapid, all of those derivatives are set up to hedge various institutions from interest rate risk and from currency risk. The Fed keeps up this ratcheting of rates that they're going to break something.
Yeah, and things are breaking all over the place, it feels like. Joel, what does this mean for the upcoming year in terms of the economy and the markets? She's talking about derivatives. Stephanie Pomboy is talking about $1 trillion in debt, corporate debt, on balance sheets that will roll over. What's that going to mean now that they're paying a much higher rate than they expected?
Well, it's interesting. If you look at the capital markets, and actually I used to do a lot of bankruptcy analysis as an academic, if you look at the callable liabilities, the liquid financial assets minus callable liabilities, and you scale it to total assets, it's a bankruptcy measure. And those companies, those specific companies that have refinancing risk are under a lot of pressure right now. And those are the ones that have the junk bonds, the single B pluses, the Bs, the triple C pluses. Those companies are under pressure. Their spreads have widened for the debt, and their stock prices are down. However, for the rest of the market, those companies that are cash flow rich, that have low debt on their balance sheets, that are in fairly stable markets, that have widening margins, they received a bonus here with interest rates dropping overall. And those companies are doing well. So we're seeing a two-tier market. Today, we're seeing the Dow and the S&P outclipping the NASDAQ, which tends to have lower financial strength in terms of higher growth but weaker capital structures. And so the market, I think, right now is moving towards more stability in the capital markets. People are moving up in market cap, I believe, for the next few weeks. And I think that we're going to see those companies benefit at the expense of the weaker marginal credits that have refinancing risk.
So how are people investing around this? What are you seeing in your ETFs? I mean, we're looking ahead this week to the final read of the fourth quarter GDP. That's out on Thursday. And then we've got the Fed's preferred inflation gauge, the PCE index, out on Friday. Are you seeing worries going into these reports? What are your expectations? And how have investors shifted their money?
Well, we've seen some shifts, in just in the last few weeks. Our fund is actually up at around 20%, close to 20%, with the number one fund year to date out of 1,250 funds. And we're starting to take some profits off the table and reallocate to more conservative names. So this is a good time for the next couple of weeks, I think, to be more conservative. You're not going to make, as an investor, this is not the time to be swinging for the fences and taking on additional risk. I think you should be conservative in these markets. Eventually, Eventually, I think CPI is going to come down with real estate, which has still been rising. Eventually, the CPI is going to recognize that real estate prices, particularly in big markets, are dropping. When that happens, I think it's going to be more, again, closer to a risk-on market. But right now, it's not.
Well, Joel, congrats. Number one fund. That's pretty impressive. Let me bring in Mike Lee. Go ahead, Mike.
Yeah, Joel, Judy Shelton, a lot of people were saying the Fed is going to keep raising rates, keep going until something breaks. I would say that until something breaks, we're not going to crush inflation. It's still persistently high. What are your thoughts as we get another reading on Friday?
I think what again has been surprising to me the last 6 months or so, we've seen real estate not only maintaining its increase month over month, 0.7, 0.8, which annualized around 10%. It's not yet shown any signs of weakening. And I think the Case-Shiller index, which many people are tracking, show that, anecdotally we're seeing evidence, particularly in the East Coast and West Coast, big markets where real estate prices are at least flattening and coming down. Eventually, when that information comes in, and we've been seeing previously CPIs going up and down primarily with energy and used car prices and things of this nature. But eventually, when the real estate, which is 30 to 40% of the index, starts coming down, we're going to see inflation really making precipitous drops in that level. And until such point, I think we're kind of in a steady state where we're looking at annualized 5-6%, maybe 0.3, 0.4 overall.
Are you seeing investors? Are you seeing investors buy up the regionals? What about your ETFs?
We're not touching regional banks right now. It's a speculative play. It's hit or miss. So we're staying away from that right now. I know some people are speculating in that area, but we're staying away from regional banks, and we're focusing on our core areas of communication services, IT, and healthcare, and being more conservative in those names.
Okay. Joel, thank you.
Thank you.
Joel Shulman joining us, ERShares.